Is China's $1.4 trillion debt package really a game changer, or just window dressing? How will Trump's return to the White House impact U.S. farmers and automakers in a renewed trade war? And why are American consumers feeling more optimistic? Welcome to The Daily Show, where we take a look at the latest economic news, market data, and stock market updates. Let's dive right in. This story was leaked a few days ago by Reuters, and I covered it here on this channel. But now China has officially announced a massive $1.4 trillion debt package to ease the financial strain on local governments. This move comes as China's economy struggles with slow growth and the looming threat of new U.S. tariffs under Trump's incoming administration. However, this package isn't the growth-boosting stimulus many were hoping for. Instead, it focuses on refinancing hidden local government debts, aiming to tidy up balance sheets rather than injecting fresh money into the economy. The finance minister noted that this refinancing could save around 600 billion yuan in interest costs over 5 years, but that translates to a mere 0.08% of GDP annually. Analysts are unimpressed. A meaningful China stimulus like in 2008 isn't coming anytime soon. This debt swap is being viewed more as an attempt to tighten control over local governments than as a true economic boost. The market's reaction? Tepid at best. Chinese bond yields remain at all-time lows, the yuan slipped, and while domestic equities saw a brief bump, enthusiasm quickly faded. China's focus on debt control without addressing underlying issues like consumption and bad debts has left many analysts questioning Beijing's approach. There's hope that China might be holding back some firepower to respond adequately to Trump's actions. U.S. farmers, many of whom supported Trump's return to the White House, are likely to face retaliation. Trump's promise of a 60% tariff on Chinese goods could lead to new tariffs from China, further restricting access to the massive Chinese market. Already, U.S. soy exports to China have dropped significantly since the last trade war, and experts warn that another round could cost U.S. farmers billions. Additionally, American farmers face tough competition from Brazil, Argentina, and Australia. Speaking of tariffs, automakers are bracing for big changes under Trump's return to the White House. He's expected to impose tariffs of up to 200% on vehicles imported from Mexico and potentially from Asia and Europe, which would make it harder for foreign-made cars to sell in the American market. Brands like Honda and Toyota, which currently produce thousands of cars for the U.S. and Mexico, said they may consider moving production to the U.S. Trump also aims to cut EV incentives and roll back emissions regulations, favoring gas-powered SUVs and trucks. U.S. consumer sentiment jumped to a 7-month high in November, according to the latest data from the University of Michigan. The index rose from 70.5 in October to 73, beating expectations of 71. This boost in confidence is largely due to a more optimistic outlook on personal finances and business conditions, with expectations up nearly 6%, reaching their highest since July 2021. This survey was completed the day before the election, so we'll need to wait a month to get data on post-election sentiment. Short-term inflation expectations dropped slightly to 2.6%, the lowest level since late 2020, while the 5-year outlook edged up to 3.1%. Inflation expectations have essentially returned to pre-2020 averages. Nippon Steel is pushing to close its $15 billion acquisition of U.S. Steel before Trump returns to the White House. The deal, which has faced opposition from Trump, Biden, and some union leaders, is now under review by the Committee on Foreign Investment in the U.S. The acquisition is key to Nippon's expansion strategy in the high-grade U.S. steel market. It's also central to Nippon Steel's aim of reaching over 100 million tons of production capacity in the long term. Let's dive briefly into some interesting macro and market data. China's October export numbers beat expectations, surging 12.7% year-over-year, more than double what analysts had anticipated. This jump was supported by a rebound in exports of mechanical and electrical products, along with front-loaded orders likely due to upcoming trade uncertainties. Notably, exports to ASEAN and the EU posted strong double-digit gains, outpacing growth to the U.S., which means we shouldn't overly credit strong Chinese exports to getting ahead of Trump's tariffs. Meanwhile, the Fed's balance sheet has shrunk to its lowest level since August 2020, down by $2 trillion from the April 2022 peak. While the Fed just cut rates by 25 basis points in November, Bank of America is sticking to its forecast for another cut in December, with Powell's comments signaling a dovish stance. Globally, the trend among central banks in recent months has been to cut interest rates. With the expectation that Trump's policies will bring inflation back, Bank of America strategists suggest investing in sectors like energy, materials, and financials, as they offer protection against inflation. Friday was a strong finish to the week on Wall Street, with all major indexes posting gains. The S&P 500 rose 0.38% on Friday, surpassing the 6,000-point mark, and the Dow added 0.59%, while the Nasdaq managed a slight 0.09% uptick. This rally came on the heels of Trump's election win and a 25 basis point rate cut by the Fed, as the market digested both events with optimism. Tesla reached a market cap of $1 trillion. The standout for the week was the Nasdaq, up an impressive 5.74%, followed by the S&P 500, which climbed 4.66%, and the Dow, up 4.61%. Small-cap stocks had their best week in years, with the Russell 2000 jumping 8.51%, driven by hopes that Trump's policies will favor domestic industries. Tom Lee predicts small-cap stocks could outperform over the next couple of years by 100%. Meanwhile, the U.S. 10-year Treasury yield is holding around 4.305%, close to a recent high. Investors are watching carefully as yields remain elevated due to expected increases in deficit and inflation under Trump, which could temper future Fed rate cut expectations. Friday's Fear and Greed Index ended up at 61, showing greed and indicating increased optimism and bullishness, as Trump's recent election win has boosted market confidence. Just a week ago, we were in fear at 44. In Friday's session, we saw a modest sector shift, with utilities leading at 1.9%, followed by real estate gaining around 1.7%, and other defensive plays like consumer staples performing well. Meanwhile, solar stocks took a sharp hit, down over 4%. Looking at the past week, there was a more pronounced shift. Regional banks surged by a massive 10.8%, reflecting renewed optimism post-election due to expectations of deregulation and lower taxes. Metals and mining also climbed 8.5%, while energy stocks gained around 6.5%, boosted by a combination of pro-growth expectations and potential infrastructure spending under Trump's presidency. On the flip side, solar was the biggest loser, down nearly 9.5% for the week. This contrasts sharply with last week's strong performance in solar, as Trump's victory likely means a slowdown in solar energy growth due to expected cuts in incentives and subsidies. Oil prices fell on Friday after Chinese stimulus efforts underwhelmed speculators, sending crude oil down 2.7% to close near $70 a barrel. Oil's narrow trading band this week reflects the market's uncertainty post-election, as investors await Trump's policy stance on the Middle East and energy. Meanwhile, gold dipped 0.8% on Friday, marking its biggest weekly drop in 5 months as a stronger dollar weighed on demand. Lastly, natural gas held steady as mild temperatures kept demand subdued despite rising inventories. This week is quiet in terms of economic data and earnings. On Wednesday, keep an eye on the U.S. CPI report, which is expected to come in at 2.6%, a slight uptick from September data. Thursday brings PPI numbers and jobless claims. And that day, Powell and Lagarde are set to speak, which could provide more insights on the next moves from the Fed and the European Central Bank. Finally, on Friday, we have retail sales data. As for earnings, watch out for Spotify, Tencent, Disney, and Alibaba. Please subscribe and hit the notification bell to stay tuned for daily updates. If you've made it this far, thank you, and see you tomorrow.